everyone. Welcome to Coffee and Conversation. We're extremely happy to be able to bring Tim Dossa back for Coffee and Conversation. Tim, thank you for making the time. Tim is a senior business consulting manager with Glenn Burdette, a local accounting firm here in San Luis Obispo. Tim is an expert in the EIDL and PPP loan programs that were developed by the SBA 12 months ago. Many businesses have applied for PPP, and now is the time to dig deep and figure out the forgiveness process. And Tim is here to walk us through some of the highlights and is going to be open for Q&A throughout the session. So please feel free to tap your Q&A button, click on the Q&A button on the bottom of your screen and ask questions, and we'll filter the questions as we go. And we'll make sure Tim gets the chance to address them as we cover the topics or content that we have questions about. So just a quick overview of who we are. We're the Cal Poly Small Business Development Center. There are about 1,000 SBDCs across the US, and we're the main SBDC for the Central Coast, Central California region. We provide consulting services, a lot of training, coaching, webinars. If you sign up as a client, there's no cost to you as a business owner, and we will help you figure out your goals, work with you to set 3-month, 6-month, 12-month goals, and our consultants will meet with you one-on-one to help you achieve those goals. If you have any questions at all about our services, please email us at slosbdc@gmail.com. It's on the bottom of the slide there. And now I'm going to thank our sponsors real quick. We are sponsored by the SBA. We use that grant funding to pay our consultants to provide services to business owners, as well as the California Go Biz office. And we also have a sponsor with Maynard Cooper, a local California law firm that provides business transactional services. And here's a quick message from our sponsor.
Hi, everyone. My name is Jamal Al-Haj, and I'm a partner with Maynard Cooper & Gale in the firm's San Francisco office. Maynard Cooper is a full-service law firm of national reach with over 300 lawyers across 11 offices coast to coast. Our San Francisco practice focuses on advising emerging growth companies and venture capital firms, including with respect to equity management, financings, employment, and intellectual property matters. We are extremely proud to be a Founders Circle sponsor amongst an extraordinary circle of other dedicated philanthropists who recognize the immense value that Cal Poly's Center for Innovation and Entrepreneurship bring to the SLO community. We hope that each of you enjoys this upcoming training and workshop and are able to incorporate the knowledge and know-how that will be presented shortly to further help grow, develop, and accelerate your businesses.
So thank you to our sponsor. And without further ado, Tim, you're up. Thank you so much for being here, and I'll let you take it from here.
Sure thing, my pleasure. Thanks, Judy. I'm going to share my screen. And hopefully you can all see the presentation.
Yes, thank you.
Okay, good. And let me get mine on my other screen. Oops, sorry. Okay. Okay. So we wanted to talk today about both the PPP loans and the employee retention credit. Some new information, some new programs coming out from the government, and probably even more after today's signing of the latest round of stimulus. Not going to get too deep into that, but we'll talk about what's going on with PPP forgiveness and the ERC credit. So some basic forgiveness facts. And when the Paycheck Protection Program came out, it was really sort of sold like this, right? But really, it turned out to be this, which made everybody sort of feel like this. There's been lots of changes. There's been lots of complexities as we've gone through it. If you look at this slide, I'm not going to go through this slide, but really these are all the different parts of the CARES Act. And you can see just how many programs, just how much there is to know, it can be really overwhelming. So if it's confusing to you, don't feel bad, you're not alone. Some basic forgiveness facts that these are some of the more common questions that I get really around forgiveness. There really is not an official deadline to file for forgiveness, other than the only thing I've been able to find is before you make your final payment on your PPP loan. You really have 10 months from the end of your covered period to start making repayments on the loan. That's the only real deadline that you want to be aware of. And for most people, if you use the 24 weeks, you probably got into, say, October, then your 10 months is going to run out sometime around July this summer. So you'd have to start paying back the loan then. And you don't have to get forgiveness if you don't want to. So don't forget that little fact. I've only come across one client that's not going to get forgiveness, but it's a possibility. At the end of the day, it's still a loan. How do you file it? Well, you do it through your bank's portal. If you have a PPP loan, you should have got an email that says, hey, apply for forgiveness here. You have to do it through your bank, not directly with the SBA. And they're the first line of defense, so they're going to look at everything first before they send it on to the SBA. What I tell everybody usually is start with the form. It can save you a lot of time if you know which form you can use. So for loans under 150, it's the 3508S, and if you're under 150, the rules are even more simplified. You don't have to worry about all the FTE reductions. The next easiest form, I would say, is the 3508EZ. And there's a number of rules that you have to step through to qualify for this form. And then there's the big form, which is the 3508. And if you can avoid using that form, it's beneficial. Let's just put it that way. This is the 3508S. So you can look at it and see how simple it is. You fill in a lot of your demographic information, and then you put in your covered period. This line about employees at the time of application for the loan, at the time of application for forgiveness, that's truly a head count. That's not the FTEs. That's just how many employees did you have when you applied? How many employees do you have now when you're asking for forgiveness? They're not going to ding you if you have less. This is really sort of a data gathering tool for the government to say, I think really in my mind, I look at it and say, well, they just want to say, look how many jobs we were able to save with our PPP programs. And then you put your amount that you spent on your payroll cost and how much you want in loan forgiveness. And that's it. And there's some things you have to sign off on that say that, you know, you follow the rules and you're not a criminal, all those good things. But that's it. That's why the 3508S form is really beneficial. If your loan's under 50,000, you sign it and go. If your loan is under 150 or between 50 and 150, then you still have to follow all the rules, but it's still the same short form. You can use the EZ if you meet any one of these three buckets. If you're self-employed, independent contractor, sole proprietor, and you didn't have any employees, you can use it. If you didn't reduce anybody's pay and you didn't reduce the number of employees over the covered period. So if you can meet both of those, you can use the EZ form. A question I get a lot on the pay is, what does that mean? And really it's their rate of pay. It's their hourly rate or it's their annual salary. As long as you didn't reduce that, you can meet that.
Quick question, Tim, before we finish up on this slide. Someone is wondering if is the business owner waiting for the bank to give us the link to the forgiveness form that they need to complete, or should they be seeking it out themselves? So what's the exact process for that?
If they haven't received it already, then they should be seeking it out, because Mechanics Bank was most recently, they've been rolling it out and they've been emailing folks about their portal. I know they were one of the last ones that I have seen as far as getting their portal out and ready. A lot of the lenders, after the forms changed and some of the rules changed, closed their portals, did some reprogramming, and are now coming back online and sending out invites. So I would say if you haven't got an email yet, then reach out to your contact and see what's going on.
Okay, thank you. And at the end of the day, just communicating as much as possible directly with the bank. There's no harm in doing that. I would check in, send an email daily or a daily call just to check in. Yeah.
Yeah, I would agree. I mean, the banks want these loans off their books and they want to get their fees. So it's in their best interest to work with you on that. And then the last one is if you didn't reduce anybody's pay, and then there's this unable to operate clause, which is sort of a magical little golden ticket. But really, if you can look at your loan period and say that you weren't able to operate at the same level of business activity as you were before February 15th, then you can check this box and potentially use the EZ form. What does that mean? We've sort of started with, we'll start with your gross receipts. If your gross receipts over your loan period and if your loan period is 24 weeks, then look at the 24 weeks before February 15th and sort of compare gross receipts and see if they went down. That's one way to look at it. Another way to think about it is, did you have delays in operations? Did you have delays with suppliers getting you supplies? There's a few different ways to look at it, but that's a very open-ended option to qualify for this form. And so now there's PPP Round 2, which most people are probably familiar with. To qualify, you need a 25% reduction in gross receipts in any 2020 quarter as compared to that same quarter in 2019. And you have less than 300 employees. It's basically the same. You can get 2.5 times your average monthly payroll cost. You can use 2019 or 2020 calendar year wages as a measurement stick. So if you use that before, you can essentially get the same amount of loan for Round 2. If you're in an industry that has an NAICS code starting with 72, you can get 3.5 times your average monthly payroll cost. So those are restaurants, hotels, hospitality industry. And the forgiveness rules are essentially the same. They have added some more expenses to the list, as you can see here. So software and cloud computing costs, any property damage costs, cost paid to goods or suppliers. That was kind of an interesting one. So that's if you had a purchase order open before you got your loan and then you fulfilled it and received the goods and paid for them during your loan period, those qualify. So that could be inventory, that could be equipment, it could be a number of things. And then anything, this one probably applies to anybody, any costs related to altering your business to meet health and safety standards. So if you bought PPE, if you had to put up plexiglass windows, if you bought masks for your staff, if you put in a drive-in window, if you created outdoor seating, all those kinds of things would qualify as forgivable expenses now. And the one thing I don't have on here is they've expanded the insurance piece of it. So before it was just health insurance, employer paid health insurance qualifies in the bucket of payroll costs. But now it's life insurance, disability, vision, dental. So there's more options there, and you can use those when you apply to get more money as well, because they're part of your payroll costs.
So Tim, and sorry, I'm jumping in just to make sure I can fit in this next question. Someone was asking, how do we document an owner's draw?
How do we document an owner's draw? So an owner's draw won't necessarily count as a payroll cost, but if it's a partnership, then you can, and if it's sort of a guaranteed payment, you can use that. Otherwise, we've seen owners sort of jump onto the payroll in order to, on the forgiveness side, in order to have more forgivable costs. But owner's draws wouldn't necessarily count as they are thought of now. It depends on your entity type, I guess is my answer. Okay, so independent contractors and sole proprietors who, before, when you tried to apply for a loan, if you had to use your Schedule C and it was based on your net income, which is kind of unfair the whole time. somebody might have a very small net income because they were, taking depreciation or paying other expenses, and they weren't getting as much money as other entity types were getting. So they changed it now. So you can base your loan amount based on your gross income, up to $100,000 maximum. So if you have already applied, if you're one of these independent contractors or Schedule C workers and you've already applied, you're sort of out of luck. This was another thing that the AICPA is still currently lobbying the IRS and Congress on. So they opened up that 14-day window for small employers because they wanted to prioritize getting money to them. But they came out with some of these rules a little bit later, and people had already applied. So they're lobbying to see if we could get some of that changed and extend the deadline as well. The one thing I would say is that if your gross receipts are over $150,000, you'll still need to check this box. It's called the necessity clause, but basically you're attesting that the current economic conditions make this loan a necessity. Whereas the 25% drop in gross receipts quarter over quarter that we discussed earlier, that satisfies the necessity clause, except if you are a Schedule C filer with gross receipts over 150,000. Like I said, they couldn't have made this simpler with all the rule changes. But it's just something to note. I doubt anybody will have a problem with that, but it's something to keep in mind. So I'm going to transition into the employee retention credit, but if people have PPP questions, keep firing them away. Because I wanted to go over this with everybody. This is a huge opportunity that's a little bit flying under the radar and starting to come out of the clouds now. But the employee retention credit is available for both 2020 and 2021. It's a credit on payroll taxes, not income taxes, but it's refundable, which is really, really nice. So it's a way to get cash in employers' pockets to help fund their operations. It's very similar to the PPP in that you have to have qualified wages and healthcare costs, but it can be very lucrative if you qualify. So there's two ways to qualify, right? So you could have had your operations partially or fully suspended due to government order, or for 2020, you had to have a quarter where your gross receipts dropped by 50% when comparing that quarter to a previous year. The big change that was implemented was that in 2020, if you had a PPP loan, you could not qualify for the ERC credit. And that was the rule through all of 2020 until December 27th, when they passed the last CARE Act before this one. They changed that and they said, oh no, if you can get this credit even if you had a PPP loan. And it left everybody sort of scrambling like, oh God, how do we do this? And now we got to go back and analyze numbers. So that was a huge change. One of the things to think about is that if I got a PPP loan and I got it from, let's say, April through October timeframe of 2020, I can't use the same wages for PPP forgiveness as I can for this credit. So April through October, let's just say that was my PPP range. Those wages, they all go to the PPP loan. Any other wages in Q2, Q4, if I'm eligible, I can use those wages towards this ERC credit. And then there's an opportunity in 2021 as well. So again, before it was March through December, now it's extended through June 30, 2021. And there might be something in the new bill that actually extends it all the way through the end of 2021. Again, I haven't read all the 600 pages just yet. So in 2020, if you had eligible wages up to $10,000, you could get a 50% credit per employee. So let's just say in Q4 you were eligible. Any employee that made up to $10,000, you could get a $5,000 refundable credit for. And you still can. You'll have to go back and file an amended payroll tax return, but you can still get this credit. In 2021, that goes up to 70% of qualified wages. But it's also not just 70%. In 2020, it was $10,000 for the whole year. So you couldn't go past $10,000 per employee, no matter what they made in the year. In 2021, it's $10,000 per employee per quarter. So if somebody made $10,000 in a quarter, and let's just say they qualified for Q1 and Q2 of 2021, that's a $7,000 credit per employee per quarter. So you can see the numbers starting to add up. It can be really, really lucrative. Again, you've got the same rules now with PPP Round 2, where I can't use the same wages for forgiveness on that and get the credit, but there's ways of doing the math and sort of laying out a timeline, we'll talk about in a little bit, to really maximize how you approach this.
So Tim, speaking of the second round of PPP, we have a question here. Someone qualified for the first round of PPP, payroll was applied at 60% use of funds. They have had no revenue at all in 2020. Are they eligible for another round of PPP?
They took a PPP Round 1.
Yeah.
Okay.
Yeah. They were able to apply payroll to the maximum amount of forgiveness that was taken care of. They have received absolutely no revenue in 2020. Are they eligible for another round?
Yeah, provided that they could look at 2020 versus 2019 and say it's a 25%. There's a 25% drop,
Okay,
which sounds like that would be the case.
Yeah, thank you. And then back to the employee draw. So one more question on that. As a sole proprietor, does that person have to make themselves an employee by filing a payroll tax return and issue a W-2 to themselves to prove payroll? A payroll expense rather than
not as a sole proprietor. The sole proprietor rules are slightly different, and they basically say you're replacing owner compensation with your loan amount. So no, you don't necessarily have to do that if you are a sole proprietor. You just file for forgiveness and say that you used all the money for owner compensation.
Owner compensation, great.
If you're an S corporation, we've stumbled across this a couple of times where you're an S corporation and you're the only employee. You filed for a PPP loan. Normally you don't take any payroll except for at the end of the year, and maybe you do something with your retirement accounts, right? And you take a draw to handle that and you call it payroll. We've had to, reach out to some S corp owners and say, hey, you need to take a payroll now during your covered period, so we can call it payroll expense and that you'll qualify. Because the rules are different for S corps than they are for sole proprietors.
Mm-hmm. Thank you.
So back to the employee retention credit. So here's what changed as well. So remember we said 2020, you got to find a quarter that you have a 50% drop in gross receipts, and then that quarter qualifies. And every quarter after that would qualify until your gross receipts were back to 80% of what they were in 2019. So if you said, okay, quarter 2 gross receipts drop was 55%. Okay, I qualify for quarter 2. Quarter 3 gross receipts drop 55% again. Great, I qualify for quarter 3. Quarter 4, I started doing better. My gross receipts only had a 10% drop. So quarter 4 would be the last quarter I would qualify. The way the rules are written, it's the end of the last quarter, end of the quarter where you stop qualifying. So you actually get quarter 4 to qualify, even though you haven't met the 50% drop. So you'd have Q2, Q3, Q4, and you're good to go. When you get to 2021, the rules are slightly different. It's actually more generous. You only need a 20% drop in gross receipts. So if I look at Q, and they changed the measurement period as well. So these are two really, really important factors. I only need a 20% drop in gross receipts, and I'm going to compare my Q1 2021 results against Q1 of 2019, not 2020. I go back 2 years and I compare. And so, hopefully Q1 2019 was a decent quarter for you, and maybe you can show a 20% drop there. you do the same thing for Q2. I look at Q2 of 2021 versus Q2 of 2019, and I'm measuring my 20% drop. There is an alternative way to measure as well, just because they couldn't, leave it simple. You can look to try to get Q1 of 2021 to qualify. You can look at Q4 of 2020 versus Q4 of 2019. And if there's a 20% drop there, Q1 of 21 qualifies. It's all here in the slide, so don't worry about writing all this down, because I know it's super, there's a lot of numbers and it's super confusing, but they've really made it quite generous for you to qualify for Q1 of 2021. And there's a chart here, which I had to X out some stuff because it was wrong and I couldn't change it. But this is basically a good snapshot of some of the rules and how you would know if you qualify or not. But again, this is a really, really good credit. What we're doing right now with a lot of clients is looking at 2021, figuring out if we think they'll qualify, because we're in March, so there's a pretty good chance you could look at Q1 now and say, I think I'm going to qualify for that 20% drop. I can also look at Q4 of 2020 versus Q4 of 2019 and see if I have the 20% drop, and I'll know that if I do, then Q1 is eligible. And so we're working with clients right now and saying, okay, did you get a second round PPP loan? Yes. Okay, when did it get funded? It got funded on February 25th. Okay, great. Let's take your wages from January 1st to February 25th, and let's put those in one bucket. Those are my ERC credit wages. Along with, in addition to wages, you also get employer paid healthcare costs go into that bucket as well. So that's kind of nice. So I segregate all that out and I say, okay, I'm gonna figure out my credit based on those wages. And now from February 25th going forward, that's my PPP period. So those wages, I'm gonna focus on getting forgiveness on my PPP loan there. And now I'm gonna make that window as short as I can, right? I wanna try to hit that 8 weeks, and I wanna try to use as little payroll expense as possible, knowing that I still have to use at least 60% of my loan amount towards payroll, right? I'm going to try to use as little payroll as possible and as much of the non-payroll costs, the rent, the utilities, some of these other things we discussed. I want to get to full forgiveness with the least amount of payroll, because then, assuming I can qualify for the ERC for Q2 as well, I want to maximize that. I want to try to get as much as I can there. So the strategy has changed a little bit. A lot of people, when they filed for forgiveness for PPP1, they said, well, I'm just going to use all wages, and I'm going to throw all my wages at it. I'm going to be way over my loan amount and I'll be good, which is fine. But now we're going to try to take a different approach.
So Tim, quite a few questions here. So again, as a sole proprietor, can the sole proprietor qualify for the employee retention credit if they are the only employee of their business? Employee. I mean, does it?
Yes. Now remember, this is a payroll tax credit,
Yeah.
so you have to be having a payroll in order to qualify for it. So that depends on how you're paying yourself, I suppose. Owner, and that's another thing. It's not, my slide's not here yet, but owner wages are eligible. The clause that's in there right now that has a little bit of gray area around it is that wages paid to relatives of a 50% or more owner are not eligible. And they defined what those relatives are. It's, spouse is sort of a question mark at the moment, son, daughter. There's a number of things that they list, but that's an important thing to be aware of. A lot of folks have employed family members during the PPP period so they could, take care of the family and get wage forgiveness. So we have to look at this from the ERC side of things. We need to look at it carefully and say, okay, who are we paying? Because there might be some people whose wages are ineligible.
And one more question here. If a sole proprietor prepares a full year of P&L statements rather than the quarterly ones, does that jeopardize their eligibility for the employee credits?
Does it jeopardize their employee? Well, if you filed a payroll tax return for 2020, presumably then what I'm hearing is you might have filed it for Q4. So you would just go back to whatever quarter you filed that payroll tax return and apply for the credit in that quarter. When they first came out with this, they gave you this quick little catch-up period that you could take any wages from Q2, 3, and 4 and sort of take the credit in Q4. But you had to get that done before you filed your Q4, which nobody even understood the rules by then.
Yeah.
So now it's you have to go back and amend whatever quarterly payroll tax return that you filed where this credit would apply.
And then, so are you going to go back to PPP or in your slides, Tim? I have a couple more PPP questions, but I might keep them on hold till we go back to PPP content. Or
there's a piece in here where how the ERC and the PPP weave together, but I'm happy to take those questions now.
Okay, let's just hit them now. Okay. For a first-time 1099 self-employed PPP applicant, what is the new deadline? And should they apply for PPP through multiple banks? So, what is there a deadline, Tim, for the new round? I mean, I think it's until funds are expended, correct?
Well, there's that, but I doubt that will hit that. We didn't hit it in the first round.
Right.
I doubt we'll hit it in the second round. Right now, the deadline is March 31st. There is current lobbying going on to extend that deadline simply because of all the new legislation that's being passed, all the rules that are changing. But right now, it's March 31st. And then as far as reaching out to multiple banks, you're not supposed to, but you can. I would say if you're going to take that approach, make sure that if one of them comes through for you, that you then turn around and let the other banks know and cancel those applications. You don't want to get approved by 2 different banks and jeopardize getting any funding. So I've had clients who have taken that approach, but I would say, go through your main bank if they're offering it and you've had a good experience. Otherwise, some of the online lenders have been great. They've been really, really quick.
And we have a list of online lenders that seem to have been pretty efficient. So we can provide that to the audience post after coffee and conversation. I have another question that talks about the combination between PPP and the employee retention credit. So I'll let you continue with the slides, Tim, and then maybe we'll go back to that later.
Okay, so the other piece of this I just wanted to touch on briefly was the fully or partially suspended. So this is an important one. Some people aren't going to be able to show a 50% drop for 2020. You can also qualify if you can say that your business was fully or partially suspended. For 2021, that's probably going to be more difficult because we really haven't had any, government stay-at-home orders and things like that. But for 2020, we had one from roughly March 13th to, I want to say May 4th-ish. We had another one in December. So there was a couple opportunities to say that you were fully or partially suspended. You can be partially suspended even if part of your business was suspended. So if you can say that there's a part of your business that makes up more than 10% of your business that was suspended, then you can qualify. So I'll give you an example. A law firm has contract lawyers and they've got litigators. And so when the stay-at-home orders hit, the courts closed. Contract lawyers were largely able to continue doing what they did. Litigators were not able to really do what they did. So if you're a law firm and you want to apply for this credit, you could say, well, this portion of my business, the litigators, I was suspended, whether that's fully or partially. And so you can analyze it and say, well, I'm going to look at those people's wages from the period of March 13th to either the period where I started my PPP loan or the period where litigators were able to start going back, doing the thing by phone that they were doing in the courts. So you can look at it that way. There's a lot of things to think about when you're looking at fully or partially suspended. did you have the ability to telework? Was your employees' work portable? Agriculture workers who are out in the field, that's not portable work. They have to be there, right? Is there a need for a physical workspace for somebody, like somebody who's working in retail and working on the register? Perhaps that's something that factors into this. And then the transition to telework. So we had one client who, took a while to transition to telework. It wasn't measured in days, it was measured in weeks. So you could look at that and say, well, that was we were partially suspended during that time because people didn't have setups at home. They didn't have ways to work from home. It took a while for our IT folks to transition those guys and order supplies, buy more computers, get them the things they needed so they could telework. That all qualifies potentially as partial suspension. There's a whole huge section of the IRS frequently asked questions dedicated to explaining this. I'm not going to go into it all now, but just know that there's wiggle room here to say that you were partially suspended. Okay, that was a slide on the wages of the owners. Okay, so the interplay between PPP and ERC. So here's I would say, one of the key twists for 2020. Let's say I had a $200,000 PPP loan and I had $250,000 of wages, of payroll cost. And let's just say I threw all $250,000 of payroll cost on my forgiveness application. And I only had a loan of 200, so I only needed 200,000. Let me see, did I miss? I think I have this slide. Nope, I duplicated this slide. I think my example two, my solution here is the wrong example, so I'm going to speak to it rather than say it. But so if I threw all $250,000 on my forgiveness application, then now I go back and I go, oh, I was eligible for the ERC credit back in Q3 and Q4, but I put 250,000 on my forgiveness application. Is all 250,000 of that ineligible for the ERC now? The answer is no. The answer is the IRS has come out and said, if you put $250,000 on your forgiveness app and you only needed 200, you can use those extra 50 for the ERC credit. So that's a nice twist that opens things up for folks who've already applied. Where you get stuck is here in my example two, which doesn't go with example one, but example two is, so now I have a $200,000 loan. I had 200,000 in eligible wages, but I also had 60,000 in rent, utilities, other non-payroll costs. Well, I said, you know what? I don't want to deal with putting all the documentation onto the portal. I don't want to upload my rent lease agreements and my rent checks and my banks and all the other things. I'm just going to put 200 grand of eligible wages on my forgiveness application and I'm good and I'm done. A lot of people did that. If you did that, they're saying you're kind of stuck. You can't go back now and say, well, wait a minute, I could have put $60,000 worth of non-payroll cost on my forgiveness application. That would have freed up $60,000 of wages for the ERC credit. You're out of luck if you did that, which is unfortunate. So if you haven't filed for forgiveness yet, this is something really, really important to keep in mind, is try to free up as many wages as you can for the ERC. It's a lot of number crunching here, I would say. Unfortunately, this is the same issue. Does that answer the question that you had there, Judy, or does that address it?
Okay, let's see. So the question was, someone is asking, was the PPP still 60-40? So I know how I can utilize the retention credit. Yeah, the rules around PPP round 1, round 2 are still the same. You have to use 60% towards payroll costs. Mm-hmm. It should just be, it should be easier now to get to that 60% because besides wages, you can include employer paid healthcare costs, which now include dental, vision, group paid life, disability, right? You've got, if you're an employer who pays those things, you've got more things to stick in that bucket. Mm-hmm. And then a more, I mean, not another question here, but that's just a more generic question on forgiveness. The business use of the home as a rent expense for forgiveness. So that would be, I'm guessing, the business office type situation.
No, you can't use that. Any rent paid to a related party is ineligible for forgiveness. So if you're sort of paying yourself rent or saying, oh, well, I've got a home office deduction on my tax return, that wouldn't count as rent. However, in that situation, what they've allowed for is you can claim the mortgage interest that you pay on the property towards forgiveness. So let me give you another example and see how it might relate. But so we've got a business, they're hardware store, and the owner owns the building and the land, but he has that in another entity, and he owns that entity too, and pays himself rent. In essence, he's paying it from one entity to another. That rent that he's paying is not allowed for forgiveness purposes because it's being paid to a related entity. However, if he's got a mortgage on the real estate holding entity and he's paying the bank, the mortgage interest that's being paid over there from that entity is allowed for forgiveness, even though it's being paid out of a different entity. It's a weird twist. So in the home office situation, you potentially could use the mortgage interest that you're paying as a forgivable expense.
Okay, thank you.
We talked a little bit about how to claim this credit. The real work with the employee retention credit is up front. It's figuring out, do I qualify? That's the most important step, because otherwise you don't waste your time with all this stuff if you don't qualify. But do I qualify, and when? What are my periods of time? Once you figure that out, then the way that you qualify is through amending your 2020 tax returns, the 941X. I'm actually having a call later today with Paychecks to try to find out like how they're handling this from their side. Do we have to coordinate things like that? This is very new, and there's still a lot of unknowns with it, and we're working through it still. So there's still questions that are going to be unanswered. For 2021, you can request an advance on this credit. There's a form 7200 that you could fill out. So if you know that you're going to have this credit, you can fill out this form. You can get an advance on it. The advance cannot be more than, I believe it's 70% of your average 2019 quarterly wages. So there's more work to do in calculating some numbers there to make sure you don't go over a cap. But the whole point of this credit was to get cash into businesses' pockets without having to wait to file the payroll tax return. I know it's a little tricky because you don't necessarily know in advance exactly how much your credit's going to be, but if you know, for example, that, hey, listen, I know every single one of my employees is going to hit a $10,000 total wage number for Q1, then I know that I qualify for the credit, then you can go ahead and say, well, I'm going to have these employees and these dollars apply. You can go ahead and apply, and you can submit that form and get an advance on it. This is my last slide, but this question has popped up, and I wanted to make sure that we touched on it, is taxability. So a lot of questions around, are these PPP loans taxable? The IRS has come out and said, no, they're not. The income is not taxable, and the expenses are deductible. So you get a double win there, which is nice. California is probably the cog in the machine right now that's causing the most problem. California has a proposal that the first $150,000 of forgiveness is not taxable, and that the expenses would be deductible, but it's not passed yet. It came out weeks ago, and it's still just sitting there. And so, our firm's sitting there saying, what are we going to do with all these tax returns that are ready to file in 5 days? Do we have to extend them? Do we wait? We don't know yet. So California is, we're still waiting on that information. And then for the ERC, we've been debating this one. Matter of fact, I typed up this yesterday, and then we had more debate later. And so really, does this credit affect the deductible wages on your tax return? We don't think so is the answer, because it's a payroll tax credit. It's not an income tax credit. We don't think it will affect the tax return, but we're still sort of hammering through the details. I think we're to the point where we're saying we're not going to extend your 2020 tax return if this ERC credit is the only thing that's sort of hanging it up. But again, it's all very new, and we need a lot more guidance from the IRS on it. And these would be the same rules for 2021. So if you're getting a PPP round 2, know that the IRS rules are the same. It won't be taxable. The expenses will be deductible, and that California is still hammering out a solution. I think that was it.
Thank you, Tim.
I know there's a lot of info.
Yeah, and and it's tough because obviously still some unknowns too. So it's really hard to plan in a very structured way quite yet until we know what all the rules, the final rules, are going to be. But thank you so much, Tim. It's always such a pleasure to have you. You provide such clear. You really help us untangle the complexity of all this. So thank you so much. Really appreciate it.
Sure, happy to help.
And opening it up to any last questions, if there are any from our attendees, now's the time. I think that's it for Q&A. So our next coffee and conversation will be in April, obviously. There is a full recording of this session that will be made available. So if you want to go back and listen to anything, the recording will be available for you. Let's see, we have QuickBooks 101, March 18th from 1 to 4 p.m. If you are setting up QuickBooks or have just recently set up QuickBooks and have questions, this is a fantastic workshop to really be able to ask very detailed questions to Damon Hopkins, our Director of Finance, who's leading the workshop. Feel free to sign up on the bit.ly link right down there. And the link is also available in the chat. And then April 7th, we have a Google AdWords workshop with our digital marketing expert, Steve Burnside. This is also a great, great workshop. If you want to understand how AdWords work and how to maximize your impact, good idea to attend the workshop and come listen to Steve. He's fantastic. And again, the link, the bit.ly link to that is in the chat as well. Let's see. I think that's it for now. Again, many, many thanks, Tim. Everyone have a great day. And if you want to follow up with us directly, you can connect to us by email, slosbdc@gmail.com. And Tim, we have one last question in the chat. If a company had no revenue in 19, how do they apply for a second PPP? Yeah, I think, yeah.
If it had no revenue in 2019?
Yeah.
But you had revenue in 2020, assuming?
Let's see. Anonymous attendee, did you have revenue in 2020? I mean, obviously, if you had revenue in 2020, you can't show that you had less revenue in 20 than 19, so you wouldn't qualify.
There is some provisions where you can look back. So if you you look back to the previous quarter. So if you weren't in operation in 2019, then you can look at 2020 and you can look back a quarter. So if you look at Q4 versus Q3, you basically try to go back to the oldest date available.
They had no revenue in 2020 either, so they would go back to 2019. 2018, sorry.
If they had no revenue in 2019 or 2020, then presumably they can't meet the 25% drop.
Yeah. They started their business in February 20, so they've had basically no revenue, I guess. Yeah, so
they probably wouldn't, yeah, they wouldn't qualify without any revenue to compare to.
Yeah, sorry about that. Yeah, it was a tough time to start a business for sure.
Yeah, no doubt.
Okay, and then a quick reminder for everyone, there is going to be an email that does get sent out to all the attendees after the webinar that will include a lot of this information. So a link to the recording, links to the upcoming workshops. So watch out for an email coming your way after this session. Okay, thank you so much for your time, Tim. Really appreciate it. Have a good one. Hang in there. I know it's the rough time of year for you guys with taxes coming due. Thank you for making the time for us this morning. Really appreciate it.
No, thank you for having me.